Spiking 10-year Treasury rates signal caution for commercial real estate. That is at the top of our list of articles to discuss today on the Gray Report. Also, we're going to be talking about a piece from Globe Street. Maybe secret distress is behind CRE market performance. Is that the case, that secret distress, conversations in the shadows? But also from Marcus and Millichap, are commercial real estate prices still too high? I think most of you probably have an answer, which is yes, they probably are. But we're going to get into the details, and maybe we're getting just a little bit closer to where buyers and sellers can make some deals happen. From RealPage, multifamily permitting is down by almost 1/3. And then from Fannie Mae, we have a multifamily economic and market commentary from August of this year. Stick around. You're going to want to get the details on all of these reports and more. If you're an active investor, passive investor, any type of real estate investor, especially if you're interested in multifamily and commercial real estate, you're in the right spot. Every single week on the Gray Report, we're breaking down all the latest articles, research reports, data sets, original opinions from the Gray Capital team to help you make some really well-informed decisions. Again, we got a jam-packed episode. Make sure you've subscribed, you liked, and you throw a comment that we can get to in the future. All right, let's get to the report. Welcome back to the Gray Report. Joined again by Director of Communications and Marketing, producer of the Gray Report, Dr. Matt Bosnagel.
Hello.
How you doing?
Pretty good. It was interesting. Is another interesting week.
It's an interesting week, Matt. There's been a decent amount that's happened since our last episode last week. Most importantly, market participants and watchers were on the edge of their seat for Jerome Powell's speech and commentary up at Jackson Hole. Last year, if we remember, he really tossed cold water on the market in terms of saying, we're going to have additional interest rate hikes. The Fed is committed to stamping down inflation, and this is what we're going to do. This year's speech, similar themes, but there were some key differences. Matt, I know I've got some analysis that I've done. Curious on your take, but just in general, and maybe tell us more about, I guess, the market's reaction in terms of the media's reaction, the narrative of what I guess Jerome Powell was getting at, because that's not necessarily the same thing of what he said.
Yeah. I think that, the role of him or the function of what he's trying to do here is to scare the markets into thinking that he still could hike rates. We were talking about this before. Last year, we were wondering, or at least the talk was, maybe he'll lower rates again.
Yeah, we were thinking about, rates are lowering by the end of 2022, certainly by the end of 2023, because we'll have a recession.
Yeah, and that has not happened. And, we had that big, long discussion last week about higher for longer, and Powell wants to keep that at the forefront of everyone's mind. Yeah. Whether or not that is going to come to pass, we have seen some small indications on the edges of an economy that is not exactly roaring, but is cooling off a little bit more. The labor's growth is still still growing. Jobs are, but they're not growing at the pace that they used to. Yeah. There's just a few little soft spots here and there that maybe it might be the case if he does lower it. Maybe it's not going to result in runaway inflation, but that doesn't matter because he's told us that it will either remain high or even get higher if we don't obey.
We have to be reading in between the lines on these talks because, the main purpose is not for him to, just to kind of wax about his thoughts on the economy. It has very specific goals and objectives. Yeah. By sending signals to the market. And the media's takeaway essentially was, Powell, ready to raise rates, continue to raise rates, get ready for additional rate hikes. But if you really listen to what he said, and I listened to the speech a couple of different times, I went through the transcript, and then I did a long analysis, using ChatGPT to really kind of help parse it out and try to see if there's anything else that I was missing, which was really interesting. I actually had to write a haiku that I posted on LinkedIn that summed it up. But it's not that they are looking to raise rates. In fact, my takeaway, my analysis is they really don't want to raise rates, and they don't feel necessarily like that they will have to raise rates. They do feel, from my interpretation, that they have done a pretty good job up to now, take away the miss on the old transient back in 2021. But since, last March or so, they have done a good job of achieving some of their objectives of having inflation move in the right direction. Powell pointed to the fact, and this was the big difference between the speech this year and last year. Last year was, these are the things that we will continue to do. This year it was an assessment of what we have done. We have raised, since he said since the speech last year, Jackson Hole, the federal open market committee has increased the federal fund rates by 300 basis points. Just since the year over year, it's been 550 since they really began from zero. He said we've seen the housing market slow down. He didn't say we've brought it to its heels, but he said we've seen price growth slow down. Not necessarily declines, but saying we have had an effect. Not the full effect that they wanted, but they've had an effect. We've seen, wages still growing, but they're not spiraling out of control. We are seeing CPI come in lower and lower. It was at 8%, now around 3% on CPI, including for all items. So we are moving in the right direction, but also acknowledging that there are these lags that still have to work their way through the system, and acknowledging those, like there's a good chance we still have some bumps in the road. Specifically, he did not mention recession once, whereas in the last speech he did.
Interesting.
He also, a big chunk of the speech last Thursday was on housing, where he had mentioned in this prior speeches housing just a little bit as an area that they're targeting. But he specifically mentioned in the speech exactly what we talked about last week, Matt, prior to his speech, was the lags related to CPI and rent growth. I mean, that was a large component of what he was talking about. And in general, some of these lags that could affect commercial real estate. That could be coming down the pike.
Can I throw an audible here and ask you to pull up the CPI? All right, because this is what, and it's going to be pretty easy to do, like, do some math off the top of my head. But not only is rent of primary housing, elevated relative to, relative to what you're seeing right now in rent. It is a big factor in the weight of CPI in general. So just looking at the rent of primary residence, and you can see here, what we're showing here is on the top left, there's a little number that says 7.569, which means that of that's the weight is 7.5% of CPI is this rent of primary residence category, which is huge compared, there's a lot of little tiny categories in here, and to make up, 7.5% is big. What it also means is that for every 10 points of, for every 10 points that this would go down, then we get what? 7?
About a point.
So it's about like a tenth. Either way.
But shelter, Matt, I mean, you're absolutely right. Just on the rent of primary residence, but rent of shelter in shelter is 34%. And we know, now, not that all of these numbers move in absolute lockstep. I mean, for example, lodging away from home, is a little bit different, but in general, housing does move in the general direction. And I think it gives us a unique insight, Matt, because we are covering housing throughout the week. I mean, it's what we're solely focused on from a micro standpoint of, our assets, our company, our markets, but also from a macro standpoint as well. I think it gives us a little bit of a unique insight into where inflation's going, knowing that, housing has been relatively sticky because it's a lagging indicator. And again, so we don't have to know what's happening in the future, as in the future CPI print, we can look into the past of market rents over the last year. Yeah,
the upshot I was just trying to get at, I was trying to do math in my head, but it is a big weight and it has a big amount to fall down. I don't think that any single category is as telegraphed that it's going to go down as much as rent of primary residence. 7.5 7.6% of CPI is rent a primary residence. It is at 8%. It is going to go down to 3 or below.
And why? And just explain to the audience about how do we know that number is going to go down? I mean, has somebody on the inside?
No. The Fed told us earlier this year. They said, actually, our rent of primary residence lags about 13 months.
Yeah.
One of the branches of the Fed did this, and they have alternatives. Now they have a reason of having this figure that does lag. Yeah. It's that like the current impact on people's wallets. Well, if you look at the private rent tracker has new rents. So rent of primary residence has all rents.
Yeah.
That's where the lag is. So the new rents have told us for the 13 months that it's going down. Now CPI is starting to go down, and it has so far to fall. Could fall to 3% from 8%, which ultimately could bring down CPI by a good half or a third of a percentage point, which is big because this is what everyone's talking about right now. These last few percentages are the stickiest and hardest to remove. Well, things continue to go down, and that's going to be a big part of removing these final sticky percentage. I wonder, if we're fighting over addressing this maybe imaginary employment situation. People are scared about overblown wage growth, when really we could just rest on our laurels and CPI will come down to earth magically by like the power of math.
Well, I think that, that's what the Fed wants to do right now. It's not in a sense, sort of rest on their laurels. They probably wouldn't say it that way, but they do want to. They want to see the effects of their tighter monetary policy work its way through the system.
Yeah.
And we know, Matt, again, from what's going on in commercial real estate with all these loans that are going to be coming due soon, which we're going to be talking about again here shortly, that's just one very clear empirical example of we still have some things to get through. It doesn't mean that everything's going to crash, but it means that there are some worry cards that we have to move beyond. Now, there could be new issues in the future, but like we're not out of the woods yet. But they are seeing that, okay, we're moving in the right direction. Let's coast for a little bit, see what happens. And then they acknowledge, there's risks for having even more tighter monetary policy and moving rates up. Yeah. There's also the possibility of moving rates. There's risk of moving rates down too soon.
Yeah.
Or not moving them up if something happens.
Yeah.
So that's again where the messaging is like, look, don't make me do this. I don't want to do it. I don't want to do it, but I will do it.
Yeah.
They will because they do see the relation to them and what happened, in the 80s and what Paul Volcker was able to do.
Their hero.
And they're like, if that's what they've learned from lessons in the past, but they also understand that they're holding something very delicate, and they do. I believe that they see the soft landing, no landing scenario as a not certain but possible outcome.
Yeah.
That I think that they're probably feeling pretty good that they think they're at least that's an option. Because it was a 0% probability according to many economists not too long ago.
Yep.
And they don't want to mess that up by being overly aggressive.
Yeah. So
it's going to be really fascinating.
And it's interesting. A lot of and it did continue in a large part the discussions that we were having last week. A lot of the reports from CRE sources were talking about what is the effect of staying high for longer going to have on the capital markets for real estate, and what their base expectations and just the impacts on CRE transaction volumes.
The reality is rates are higher and they have been higher for longer.
Yeah.
And so, we're talking about, CPI continuing to cool off, that which may eventually lead to lower interest rates, but it's not a next month, next 2 months. That's, we've got some time. It's going to be too late, unfortunately, Matt, to help out a lot of borrowers that are looking to refinance in the next couple of months. Yes. And let's move over to the CBRE article. Specifically, spiking 10-year Treasury rate signals caution from commercial real estate. The 10-year Treasury, Matt, is at its highest point that it's been in over a decade.
Yeah.
It's not making transactions easier. A bunch of borrowers are saying, we'll get off this floating rate debt, we'll put in some fixed rate debt. They thought they were going to be paying 5.5. Now they're paying 6.25.
Yeah.
That means they have to bring more money to the table to keep their deals.
And that's the big point that I wanted to make in regards to the Marcus and Millichap article about CRE prices being too high. But when it comes to the 10-year Treasury rate, CBRE predicts that it's going to be at 3.5% in 2028. That's lower than it is now, but it's certainly not as low as some people would expect it to be. I think that this represents a little bit of a shift from CBRE, which not too long ago was predicting a recession in the same way that I always lump them in with Fannie Mae as someone with a more dismal expectation for the economy. And they were someone that was saying, yeah, rates are going to go low because there's going to be a recession. But this says maybe there's not going to be that recession that resets the rates, because it's not only is it going to be at 3.5, which is not as low as it was as it could be, but it's going to take 5 years to get there. For their that you were saying high for longer, they define longer as 5 years, which I think is healthy.
I think it's healthy,
but that's not. It's way too long for some people. Think longer. Well, oh man, a year's long enough.
It's in this business. Yeah, an extra couple months seems long. I appreciate CBRE, putting this graph together and making a forecast for interest rates. How useless is it though? Yeah, I mean, and it doesn't really help us because, as Jerome Powell said in his speech, and this was my favorite line, is he said, once again, Matt, we navigate,
yes.
we navigate by the stars under cloudy skies. And I'm like, oh, some nice little poetry to insert in this very dry subject matter. He basically said they're flying blind a little bit. They know that they understand how, they know how to read the stars on the charts, but they can't see any of them. All the indicators that they're not there. They don't mean anything. We're going on feeling, intuition. He basically says the data's there, but like the data doesn't mean anything.
Yeah.
So and we can project and I was using ChatGPT and AI. I was trying to do some forecasting on CPI, and it was essentially this very similar result of this CBRE, which is like, okay, generally based on the direction we are going now, we can do a very standard kind of linear regression, like in that same direction. But it's going to be so crude. Yep. It's like literally just like where the wind's blowing differently one day or the other, and you're gonna freeze frame that windsock. Yep. Or the weather vane and say, okay, that's a direction.
But the curve where
extrapolate out.
Yeah.
But what happened? Russia and Ukraine war. If that comes to an end, what happens if we drill more or less oil?
Yeah.
I mean, and energy.
Technological improvements. Whatever.
In any other black swan,
famine, war. Lots of things. That's why
will happen before 2028.
That's why I wish, if I was doing it just for fun, might as well, if we're making stuff up, make those lines a little squigglier. And if anyone asks, well, I'm sure just weirdness.
It's like, because we don't know the future. Yeah. And that's why when I was trying to do it with ChatGPT, I was just trying to do 3 months.
Yeah.
I was like, just the next 3 months. Because I was like, we know like enough, especially like and I was just looking for CPI. And we just don't have a crystal ball. And the smartest folks, or supposedly the smartest folks.
Well, okay, so I would
Federal Reserve. They don't. Yeah. They do not know. And every economist has basically gotten it wrong because we're just in an environment we don't understand. There's not a good analogies or analogs.
So I will say, just looking at the pattern itself, there is a decision here, and when CRE made this chart to start their gradual they basically applied the historical slope to the current present moment of high interest rates. They could have said, okay, there's going to be a reversion down to where interest rates would have been, and then we'll start the slope there. But they're saying that there's not going to be a reaction to the higher rates of it suddenly going down. They're saying it'll go down at the rate it was. I think it's a little bit of a statement of like, no, there's not going to be that economic crisis.
Well, and this is also, it's not just giving us information on their assumptions of interest rate, but it's also inflation, which they're obviously pretty well correlated, but don't necessarily have to be. What they're saying is, because they're saying what's the real rate, which is, what the rate is minus the rate of inflation. And so they're essentially, if there was a divergence in their forecast for interest rates versus inflation, which would be a little unique, but it can happen. you would see these lines acting differently, but you don't. I mean, you do a little bit here. There's a little like at the end, and or there's a little nip that happens that's like unrelated to.
So there's their little reversion,
I guess, but they don't know. I mean, we don't know.
They do talk about some factors, and maybe that's the kind of added value. Other than, I do think this is a statement of like, it's higher for longer, or at least much higher than people thought, based on previous expectations. They have 4 factors that they say are little short term issues. Well, not little, but they're definitely roiling the markets in the short term. They said maybe if growth is more resilient than expected, even though I think it's shown signs of cooling in recent months. They also note a near term bulge in government borrowing that just kind of compared to previous quarters, and they're expecting a little bit more government borrowing, and that's going to have an effect perhaps on rates. And then quantitative tightening, they don't really say that quantitative tightening matters in terms of its impact on the 10-year treasury, but it could matter because of like the craziness of the market and like that psychological effect. And then finally, they throw in the specter of U.S. government shutdown. We didn't talk about that, but what if there's a government shutdown? That's another squiggly.
The whole I think coming back to not just a government shutdown, but I mean, that's a lot of interest payments and debt service that the federal government is having to pay for issuing all these bonds at higher and higher rates. And the Federal Reserve, we just were showing this chart on the balance sheet. The balance sheet has been reduced, which is essentially also putting tighter pressure on the monetary system in the United States and the world. They're the largest buyer of bonds. Has actually been, no longer buying these bonds. They've actually been selling them, getting off their books. They'll probably only be able to go on for so long, and they're going to have to reverse course and begin buying bonds again for some, I think, purely like technical reasons. I don't. We're according to this chart, we're not there just yet. But yeah, I think there's going to be a lot that will unfold over the next 3 months, and these forecasts will most likely change.
No.
It's every 3 weeks, right?
Yeah, I agree. I was just very interested in, I like it when people put their money where their mouth is, where they make that prediction, even if it's wrong. You got to give it to someone for putting themselves out there and saying something about it. And the fact that this really diverges, I think, in a meaningful way from their earlier predictions of a recession that would cause lower rates is worth mentioning. And I think is a signal that people they're maybe signaling to the CRE market, like, get you guys head in the right place, because this is what you have to look forward to. Otherwise, you're going to be you're going to be wasting money. And that kind of leads me into both the Globe Street article and the Markets at Millichap. My big responses to it is this cost of waiting. And what, call it opportunity cost, call it a like lost return or whatever. There is a cost. Globe Street calls this secret distress. I just think that it's a larger
secret distress.
Yeah, I know. And you know what? That's a good headline. So I can't really complain.
And there's also a maybe, because it'd be different if it was secret distress is behind CR market performance. But it's maybe.
And they're defining what they mean as secret distress as a pretty open thing. So they could have just said secret distress is behind CRE market performance.
It reminds me, Matt, of some commentary I heard recently on the commercial real estate sector. In that it was a good analogy of that. We're in the eye of a hurricane right now, where things seem pretty calm. Not seeing that many foreclosures. But the wind is just roaring around a couple miles outside. And when we did our research analysis, and you're working on an update for our loan maturities report, that's going to be really exciting. But it was pretty clear when we did put out the initial report a couple months ago that we would see it would be very calm up until October.
And I keep thinking about this. I think the reason why we're not hearing so much panicking is because a lot of these people, their jobs are to remain calm. Bankers, they're going to remain calm. They don't want to cause, there's a stereotype of a bank run.
Advantage. It does no service to panic and move before you absolutely have to.
Yeah. And I'm not going to name names, but if you look at some of the interviews with some of these syndicators that are potentially in really big trouble, you see in the interviews, There's not a drop of sweat on their face. They are calm, cool, and collected because they've got practice. They know how important it is to put on that facade of calm.
And I also think there's a take a certain
delusion.
It takes a certain mindset to get to where those folks are, and you can't be doing it with self-doubt. I mean, you have to have like, we will figure it out mindset, no matter what it takes. And so what that can be a weakness also of not being able to see reality. But I think that's where that confidence comes from, is just that building that mindset over time.
Yeah. But yeah, so to kind of bring this back into the Globe Street article, I did take a little bit of an issue with their definition of secret distress, but I like I think they're paying attention to the right thing, which is like the low transactions in the CRE markets, which we'll get to the Marcus and Millichap little video as well. But Globe Street pulls in some data from Green Street as well. And basically, and here's the quote here.
How are they on neighboring streets?
I don't know. That's good. Globe and Green. I'm going to contact. Very sure right after this.
Yeah.
So here's a quote from Globe Street. One factor many sources have been telling Globe Street is that any owner that wasn't under pressure for an immediate refinance, which is most of them, could likely afford to wait for property values to recover. That would mean, in effect, a large number of distressed properties for which there was financial pressure in the sense of falling value could upset expectations, but not nearly enough to force a sale. Call that secret distress because it doesn't show up so clearly.
I take two issues. One, it's not really distress. I think it's a poor. Your paper value, your unrealized value, can go up and down on. I mean, how frequently do you want to market? I mean, on a daily basis, weekly, monthly, quarterly. They're in, but when the only time it actually matters is when you sell or when you refinance. So there's a capital event. That's the one time it really, not that it doesn't matter, but to say that it's distressed, if the property's 95, 100% occupied and is cash flowing, positive DSCR, above 1.2 or so, but just because the market cap rates have increased, therefore the values drop down, I certainly wouldn't call that, distress.
I think, from
a technical standpoint.
Yeah, I think the word distress is kind of leading in the wrong direction. I think of like pockets of opportunity when I'm thinking about distress, but what's happening and what he's describing and classifying as secret distress is something that I think is almost a more powerful effect of like this lost opportunity cost. And here's an example, and you can show me and tell me where I'm going to get wrong.
Yeah.
So this is just reasons why property owners sell that aren't, there are reasons why property owners sell that aren't limited to fear of declining values. So here's the example of this lost opportunity cost. You build out an investment strategy for 5 years where returns start declining if you hold the property for longer. That's just like in your plan. But then bad things happen. You were planning on selling in maybe, let's say, November of last year, but rates were a little too high and you knew that you weren't going to get a decent price. So you're you're still waiting now. It's 10 months later and you haven't sold, but your returns going forward are not as strong. The difference between those lower returns you're facing currently and the ideal returns that you were planning for, I think that's the real cost of these lower transaction numbers. It's not just falling values, it's the aggregate opportunity cost of shifting investment strategy, what are stagnating commercial activity, things you wanted to do then that you can't do, that you didn't do. And even though this Globe Street article ends with the idea that we're not facing crisis, like which it does, it's like, these bankers tell us that we've all got things under control. It's not 2008, and that's all true. I still think that the markets still have room to move, and the lack of activity is building something up, and it's not good.
I mean, the reality, just on the ground, what we're seeing today is we're seeing the market get much closer to a point of balance. I don't know if we're 5% away, but we're getting closer. I mean, we're seeing sellers' perception of the value aligning much more, again, with reality and closer to buyers. I don't think we're all the way there yet, but I mean, we're seeing deals now, that are nice deals that are in the mid 6 cap range. And again, we were in the mid 4 cap range, just a year and a half ago. And so we are looking at discounts from the peak of 15 to 30%, which is on the buy side, it's very attractive. The challenge is, though, you still have interest rates, so your cash flows still look pretty low, especially compared to where you can get, going out and get a bond, and the total returns look, IRRs look okay, but they're not like so excited to get enough investors off the sidelines, but they're getting closer and closer.
Okay, that's good. And that's a comment that I did have written out in the notes. It does just seem like, it has seemed like this year that so many people are waiting, and then knowing human psychology, that they're going to wait till it's too late, and then they're going to overcorrect in the other direction where prices dip down even lower. But it seems like, and it's reassuring that things are proceeding a lot more smoothly, a lot more logically. And that's my hope, is that professionals are.
We've been moving because, for a variety of reasons, some people do need to sell, and there's not everybody. Because you're absolutely right. If you don't have to sell right now, why would you? Unless there are other reasons. And there's some fringe, maybe not very fringe cases, but another scenario why someone maybe has a longer term loan, but the interest cap escrows. So if you have like a floating rate loan, it could be a long term loan, but you have to escrow to repurchase a rate cap. Yeah, and so you're putting maybe hundreds of thousands of dollars that's not going to investors, it's not going to CapEx, you're putting into an escrow account to buy another interest rate cap. So that's sucking returns out of an asset. And so then you ask yourself, okay, is it better to just turn this asset around? Because I've got a couple $100,000 sitting here in this escrow account I can't even get access to, but selling it doesn't look attractive, but can I get close enough to where I don't want to wait that 5 years? Some people just are impatient because, like to your point exactly, Matt, I can wait 5 years, but if all remains equal, my IRR is going to go down. I'm relying on getting some NOI growth and cap rate compression to get, a better return for my investors. Which is, we could say, and we could look at that CBRE chart and say, well, interest rates should be going down and, property values should be going up, which I think both of those things are true, but, you don't know when. And so whether, again, is it 18 months, 3 years, 5 years, 7 years? That's up in the air. And you need to make sure you have that long to wait. But that may be too long for some people. So it's tough. It's tough right now, being a buyer or a seller of trying to make those decisions. But we are the one group that just most have to make decisions are the developers. Because all of those projects are financed through, construction loans that have a short term that are floating rate. And I would say almost none, very little, we're making the exit assumptions that reflect the current environment that we're in today. And they just don't know what to do because I was talking to a developer last week and he's like, basically it's like, we're in a tough spot. Like we're in a really we were building all these deals in 2021. Now, what do we do? And it's like, well, love to buy some from you, but they're like, well, we want to sell them for what we thought we were going to sell them for. And it's like, well, what world are we living in? And it's like, that's great, but it's like, okay, well, we're not going to make a deal. It's like, because I'm looking at the market and we should be getting a 20% discount. And interest rates are here, therefore cap rates should be here. And that's the world that I'm living in, I think is like reality. But, everyone's perception makes up their whole version of what reality is and what their value is and what they put into it and what they thought. And then maybe there's somebody out there in that hope that interest rates would come down by now and that the prices would stabilize and money would just rush in, whether it's rescue capital or new buyers or just debt. It's not coming to save the day. The rescue capital. Well,
this is where this is where you hope, and I don't know, where you hope that kind of the market could maybe solve it in terms of like competition. So maybe there are developers that are like, I'm going to wait for a good price. But then maybe there are other developers that are like, oh no, I realize rates aren't coming down. I better get this thing sold at a good price and move on.
And that's the thing. You don't need every seller to decide at once. You just need one or a few to start setting to make a market. And just start setting a price and be like, well, the last 3 sales comps were all at mid-6 caps. And don't come here talking about 4.5 cap. That's not the market. Don't point at those. People have been pointing to sales in 2022. Don't point to those. Don't. It's not. We're talking. What happens?
It was if we were arguing now, this could be. I don't know what the margins for profitability are for developers, but if it is a case of we're either going to lose money or make money, then that's one thing. But if it is like my hopes are different, then the alternative is waiting it and developers operating this asset and managing the asset for a little longer and not making as much money as they could if they just continue to build and move on to the next project.
Exactly right. That's not necessary. A lot of different types of builders out there. You got your merchant builders. You have your builders that are building it to hold on to forever. It's the merchant builders that both are in a tough spot because either one, their exit is a wrench has been thrown in the gears of their exit.
Yeah.
If you're buying to hold on to, the refinance doesn't make sense. You're going to have to bring money to the table now to even keep the deal. You've already taken a lot of risk on.
Yeah, I see this too. It's like, I'm saying, oh yeah, just sell for less. I'm sure they got business plans. People they got to fire now because they're taking in less profits and now they have to lower their prices. Like, sorry, buddy.
We needed that money to pay our hard staff.
Yeah.
And
I'm next.
No, we're not in that spot.
Yeah.
Fortunately.
Yeah.
And so that they can't. They have to look at refinancing, but they can't refinance, and so they're like, well, maybe someone can sell it. I can just get out. And on the merchant side, they weren't planning on managing these. They're not really set up to do it. Can they? Maybe, but then they still have to figure out the refinance.
Yeah.
And then some have seen, and this is where I don't know of what the position of some of these folks are, because some have had so much success. They've seen so much success over the last couple of years.
Yeah.
I mean, I can't tell you how many times I've seen a deal sell for where they've made tens of millions of dollars more than they thought. I remember seeing a pro forma when they were going to build it, and then I didn't invest in it. Just was doing our own deals, and I'm looking at it when it came out to sell and knowing what they sold it for. And I'm like, you made $30 extra million.
Yeah.
And then they did it over multiple deals. So that adds up and made me a good position. Now, is that liquid? So it's is that
yeah.
So some of these, my point is some of these guys are well capitalized, and so they have the cash potentially to come in and fix a deal or to push it down the road if that's what they want to do. But it also gives them this interesting position where large developers or large private equity firms, like a Blackstone or can be in we can have a deal where we don't make money and we still look good.
Yeah,
we've had we have 100 deals. If one we break even on, it doesn't really matter.
Yeah, I don't want the headache of having to do all this extra stuff, refinance and
time value of money. We can go on to the next deal and start and hope to try to make a couple, a big pop on the next one. Like this one didn't work out. And it's not our fault.
Yeah.
It's interest rates or whatever. We didn't forecast whatever. Let's just move on and stop wasting our time on it. And so, where that developer is and where their head is, that they could just say, they could be in that position, but they could say, absolutely not. I don't want to sell it to break even. I want to make money on each one. I'm looking at this as I'm gauging success on this specific project, not my overall portfolio. And then, will they sell it at a loss just to get it done? We bought a property last year, Matt, you remember, that the seller sold it to us at a loss because they were a REIT and they didn't need, it was like part of their portfolio repositioning and reallocating. They just needed to get it off their books. How much of that's going to happen?
What would have happened? And what would have happened if it could have been a greater loss?
It could have. It's exactly what it 100% would have been.
Yeah, I think that those developers that are able to move forward are going to, and this is where I say they're probably going to outcompete the developers that are unable to find whether these people move forward because they're able to, or whether they move forward because they have no choice. It's hard to see that they're maybe going to have an advantage. Maybe they set up a new project with the right assumptions and now we're in a high rate environment. We got to do things a little bit differently.
Well, now the environment, and this is the effect. This is the effect of this monetary policy and the environment we're in the even if people see good prospects for the future, it's hard not to be overly conservative.
Yep.
Whether that's, you don't want to be perceived as being overly aggressive and kind of going against the general zeitgeist of, the investment, world. Or just, you're not, how can you be so confident? How could anyone be so confident in a the brightest future for, real estate that kind of relies on interest rates. You don't need low interest rates to be successful in real estate, but it certainly helps and to get the deals done like they want to get them done.
Yeah.
So the result is everyone is being overly conservative. I mean, to a point of where it can be too conservative, and which that brings down the prices even more, because it's like, I can't do that deal because I can't assume that kind of growth.
Yeah.
And it's like, because people say, well, we're going to have high inflation, but we're going to have rent growth. I'm like, well, that doesn't necessarily make a ton of sense over time. Like in 1 year, like this year, we've got some inflation and we have, very, tepid rent growth. But that was after a couple of years or 2 years of crazy, insanely high rent growth. So it's kind of makes sense as the rent growth kind of, outpaced inflation and let it a little bit. But, the idea of having, no rent growth or rent growth at, 3% average, when we're going to have inflation, when inflation was at 2 and 3% in the past, but we're going to have inflation that's, call it 2 to 4%, but we'll have less rent growth. Like, that's possible, but I think probably unlikely. And, projecting inflation, we're projecting we have, 3% inflation going forward, but, the Fed is certain and confident it's going to get down to 2. Yeah. So that's all being baked into, pro formas and underwriting, and it's made it more conservative, which I think is helpful, but it's, again, that's where the, I think it's where some like art comes into place in strategizing and balancing, and certainly there's a lot of science too. But we also it comes back. I heard this, and this is it's not too off topic, but what is the real purpose of like models? Like, do they have much value? And what is the real value? Yeah, and I think our perception of the value of models is much different from what it is in reality. Very few models aren't good at predicting the future. Yeah. It's just like the only thing we have to look at, and it makes us feel better about it, and it helps us process and think through a problem and put some numbers to it. But it doesn't it doesn't do a good job. Well, if we look at our models, and I'm not saying we're bad at it. I'm just saying, look at anybody's model on anything and compare it to the outcomes. Like, they're not usually very, to like the good or the bad. Yeah. Like the standard deviation is it's all over the board. And so we have to have some humility of like, we don't know, but it's like, we just don't have the tools. We don't have the proper tools, and I'm not here today saying like, here's the way we should be doing it. But man, we are, as an industry, we're pretty ill-equipped to figure out what's going on, and we're making a lot of big decisions. And so I think it takes it demands a larger understanding of kind of the fundamentals and which way the winds are blowing. And sometimes making broader conclusions are better than living in the weeds, in all the minute details, and trying to create an analog of like the world, of which is so complex. Yeah. This has been it has been a period of change, and after a significant lengthy period of things didn't change much. After the great financial crisis and the pandemic hit, things are still changing, and that's going to make models different, but that's also going to make people scared to act when things are so unpredictable, whether it's interest rates or rent growth. Yeah, but it's lack of information and further uncertainty of like, again, coming back to Jerome Powell's comments, we navigating by the stars, but the skies are cloudy. There's nothing to see. There's no stars to see. Yeah, but after a certain point, the models from before don't work. You can maybe look at the last year or 2 years, or model a little bit in the future that doesn't rely on hopes, that relies on things that actually happen this year. Like, for instance, is there going to be a recession or not? Or, for instance, are interest rates going to be high or not? I know it's not certain, but it's becoming more certain than it was before. And inaction is not helping anyone. True. True. And we have to, I mean, it's like what the beauty of the human spirit is, like, we pursue to endure and tackle like the seemingly impossible. We're trying to predict the future. I mean, we've done a lot of great things, as a species, why not making a true educated guess with actual assumptions. But again, just that's the goal and the intent, and we feel strong because like we've modeled it out. But again, looking back to all our models in times where it should have worked, and they didn't do a very good job.
Yeah.
Like, I'm just thinking of every deal I've done, every real estate deal, and I'm looking at the models, and the vast majority of these have worked out like to the upside. But like, you didn't do why did you model a 14 IRR when it's a 40?
Yeah.
Now you could say like, oh, we didn't want to but like, so again, we're admitting that we're just we're forcing the conclusion into what we would like.
Well, that's what I was gonna say. Models are there to help you feel good about your assumptions. Feel good about existing.
To make you feel good about assumptions, and again, I think it's a false sense of confidence. Real estate deals, back in the day before Excel, I mean, like it was not like this is exactly what the cash flow. Broad strokes, people did really well. Now it's because the whole industry was doing that, and I'm not saying that like you just go off our gut and that's it, but I think re-examining and just questioning the way that we analyze. And again, it's not just like buying an apartment building. It's how do we model inflation? How do we model and forecast all of this stuff? And and just because there's like a desire and intent, it doesn't mean that like it's something that we can do.
Yeah.
At least in this way, it's like the what's not Midas touch, but what's the science of basically turning into gold?
Like Rumpelstiltskin?
Yeah, Rumpelstiltskin. No, but there's a whole like science.
Alchemy.
Alchemy, exactly. Yeah, alchemy. Yeah, it's like
not Rumpelstiltskin.
Like at some point we realized like we're not just going to be able to like create gold from from nothing.
Yeah.
But there was a lot of effort in time, in effort, in human energy that went into that. And on one hand, it's like, I don't know, maybe we'll find out that it is possible. We're just missing something. And again, we can solve the impossible, but like we should look around and examine and try to be self-aware of like, what are we doing?
Yeah.
Like, is there a better way? So anyway, that's my little rant on.
But if you want to move on to the John Chang, Marcus Millichap article, which it does touch on this point, CRE transaction activity, they're pegging it as down by 41% in 2023. The big thrust of this article is that like we were just talking about, buyers are saying prices too high, transactions are low, sellers not motivated, everything we just talked about. But John Chang's emphasis here is not on the lowness of transactions. He's kind of saying that they're not as bad as we think. He's in a way, and he's not saying that like everything's great, but in a way that other sources are really shining a light on low transactions. He's kind of trying to, or he's at a less dramatic. Let's just say that. I'm a little split on his reference frame here because they're saying that CRE transactions are down 41% for properties over 1 million. Even though their point that they make is that transactions are still above their 20-year average. I'm a little split.
Are they talking about by dollar volume or just like pure transaction volume?
By dollar volume.
Well, yeah.
Or no, wait. I'm sorry. I think that yes, it is dollar volume, and that's what I was.
But like you can do less actual transactions, but everything's worth more, so it doesn't seem as bad.
And inflation.
Exactly. Inflation. There's been a little bit of price appreciation.
Yeah, he notes that current transactions are at the level of 2015, which was not so long ago. Not a quiet year for CRE sales if you're looking at the bar graphs that he was showing. But due to inflation, $1 in 2015 is worth $1.29 today. So like
there's 30% right
there. There you go. So I do think that the transactions are a little lower than maybe they characterize it. But it is a useful, it is a useful thing.
Oh, Matt, we've got
good
Gray Res managers team.
Good.
We're having a managers meeting today here at Gray Capital. All of our awesome property managers across the Gray Capital portfolio on the Gray residential team. here doing some training, meeting.
Sweet. That was fun.
Having some fun.
Maybe
we're having lunch.
And I did, so to go back to the John Chang article, I pulled up a Newmark and a Colliers report from last week that gives an additional context here, and one that's a slightly different than the graphs and the figures from Marcus and Millichap. Now, Marcus and Millichap say that transactions are down 41% from last year, but if you look at this graph from Newmark here, it looks like they're down far more than a simple 41% from last year. It looks like they're down half the volume.
I mean,
so
I may not be the most visual person, Matt, but that looks like way less than half.
Yeah, and the equivalent for this is not 2015, more like 2010 transaction volumes for the first. Okay, so I'm sorry. I gotta go back here because we're only halfway through the year.
I mean, just think about. 2020 was a soft year.
Yeah,
I mean, like a slow. And people didn't wake up until the end of the year, and then there were a decent amount of transactions. Like, I'm surprised it's even at that level. But I mean, like, just to think about that, like, that we've done a fraction we did in the year of where we at least thought there was a global pandemic that was going to disrupt the whole world. That did disrupt the whole world. You know?
Yeah. Oh, yeah.
People were still confident enough to keep buying real estate.
For sure.
But now we're like, oh.
Now we're less. Now, and those first, you can see right when the pandemic hit. So 130 billion in transactions in the first quarter of 2020, 48 in the second quarter. Then it kind of bumped back to 76. And
makes sense.
And then it was up from there. But again, this does not compare. It is less than half than the year before. Now, if you go to the Colliers, now this is specifically, and we talked about this last week, but this does bear repeating. Multifamily volumes, as Colliers measures it, are lower than any other.
Yeah, and then they're looking at units traded.
Okay.
Right.
And that may make sense a little bit because the Newmark figures had hotel sales as the smallest transaction volumes. But if this is maybe you can justify that with the units traded. But either way,
again, and it's another great example of how you can manipulate data and certain narrative can be.
Not that we have a narrative. We're just the truth.
We're just the truth.
I still
no. Yeah. Everyone has their own bias. Mm-hmm. Everybody has a narrative. You can try to take it away as much as you want. You know, we are trying to buy apartment buildings, Matt, at great prices to make them, if they're not already, incredible communities, make a lot of money for our investors, create absolutely incredible living experiences, for the residents at those properties. And in order to do that, we need to buy buy at reasonable prices. Yeah. And so, like, taking the veil off. I mean, we want there to be more trading. We want price discovery. We want the price discovery. We want the market to move to where it needs to move. I mean, you've heard me say this a lot, Matt. The market needs to hurry up and move to where it should be. My perception, but just looking at understanding economics just like a little bit, like not an economist, but like just a little bit of like relative to other investments.
Price was right. People would be buying. And that's what John Chang began the whole thing is why his quote is, and this is worth, he says, it's questions like, why are you going to invest in real estate when you can make 5.5% on a 6-month treasury? And most commercial real estate properties on the market are offering a cap rate below the cost of debt. Why, Spencer?
Yeah. Well, and especially when prices hadn't moved. So it's not like, oh, well, you're getting 5%. There's going to be a big upside. It's you're going to get a yield lower than you could get, basically a risk-free bond. And you're going to be buying at the top of the market. So your total return might be lousy as well. Where we're shifting now to where, okay, you are getting a discount. So like there is a potential for some nice upside, but the yield is still going to be higher than it was before because you're getting a better price, but still low because of where interest rates are. If you're buying at a 7 cap, if you're buying a deal at a 7 cap, which I haven't really seen any 7 cap deals that are the larger deals that we look at. Seen a couple mid 6s.
Yeah.
But if interest rate's 6 to 6.25, you're only getting so much positive leverage. You can only get so much return, and then you have to execute your business plan before you can really start getting NOI up over the next year or two. But there is an emerging reality of, okay, but we are buying 20 to 30%, off the peak, and we're getting a discount, and relative and where it gets even more interesting is, what is that price relative to replacement costs, especially newer properties.
Yeah.
So it's okay. I'm seeing like if it's like a Class A, brand new construction, maybe one of these developers built, they got to get out of, like we were talking about a couple minutes ago, and they're bringing it to the market at a price that it's like, I couldn't even build it for that.
Yeah.
Or it's a 30% discount of what like a couple years ago it was. Then that's starting to become intriguing because it's not too many things have to happen over a period of time. It doesn't have to happen right away, but it just, if interest rates and cap rates sort of normalize, there could be a ton of upside. And if it works, if they don't, okay, interest rates stay high, cap rates stay high, we don't get a lot of rent growth, and it's a decent deal. Like it's not going to look awesome, but it's going to look good. Okay, if my base case is good and my worst case is acceptable, I'm still making money. Not gonna make a ton, but I'm making money. But then there's a huge room for upside.
Yeah,
that becomes attractive because again, a couple months ago there was no upside. It was only it can just get worse and it doesn't look good, and this is how we lose money.
If you were staying out of the market, you wouldn't notice this kind of gradual shift towards a more favorable situation.
No,
that's really interesting.
No. It's either you're in the market or you're watching the Great Report.
Yeah. Well, please do both.
And so that's what. So give us. So I would subscribe to the Great Report.
Yeah, and I wanted to note this too. We're motivated. We want the market to move. Marcus and Millichap is also motivated. They want people to.
Well, now the brokers, the brokers are past the point of where they think the market's going to come around, so they want it to move because they're like, look, I'll sell it at the lower price. I just want to sell something. Yeah, I get that. We're going to be selling it for lower prices, and the seller is disappointed, but I want to transact so I can make my commission.
Yeah.
And so I think the effort has shifted from appeasing sellers and being like, well, we can wait, and I think interest rates will lower, and they were dragging them along, and I think probably telling themselves that a little bit too. But we're kind of past that point now. And now the higher for longer conversation is entering conversation.
It's so interesting.
It's like, hey, okay, Mr. Seller, we waited.
Yeah.
Time to go. Time to bring it to the market. I want my commission check.
I want to feed my family this year.
Yeah.
Like some of what were you were saying this a few weeks ago was Cushman & Wakefield's transaction volume was down 80%. Now last year was crazy.
Yeah.
But that's kind of, there are probably
you see some of the
people in dire straits.
And I think it's Cushman & Wakefield and maybe a bunch of these big, large commercial real estate shops. You know where they are invested in?
What?
They had decent positions in?
Office?
WeWork.
Oh, man. Even worse. Okay.
Even worse.
Office?
So.
Yeah, that's interesting.
Even worse.
Yeah.
Okay, Matt, we got to hop on this managers lunch, which is
understood.
Getting the team together is awesome. Have you gotten used to the new Twitter X? I say we need to hurry up now. I'm going off on a tangent. I do like the logo better than the bird.
Yeah, I like the logo. People say it is, it's a copy off a mathematical symbol, but it's a cool looking mathematical symbol. So I like the logo. Who cares?
Yeah, I think it's definitely just Elon Musk being like, it's cool.
Yeah. So cool. All right.
Yeah.
That's how I judge it.
Yeah. Anyway,
well, no,
you can see
now, be a clip.
I have not been diagnosed with ADD, Matt, but
not yet.
Man, not yet. But look, if I can get that distracted, who knows? Usually I can get distracted by good things. Okay, RealPage, what's going on? Permits, they're down, Matt.
So again, I know we're a little pressed for time, but this RealPage and Multifamily report are covering the same thing. Multifamily permitting down. Fannie Mae really focuses on the actual construction completions that are expected. And if you look at this chart, you see the crazy number of completions that are expected in 2023. Specifically, it looks like the third and fourth quarter of 2023 are going to be the real time when we're going to get dumped with units and units.
So much is happening in the fourth quarter, Matt. In the economy, real estate. I mean, you hear like the triple witching. Like at the end of the quarter and a half of it's like all. It's in public markets when, there's like all the different contracts are all expiring on the same day and a bunch of technical stuff has to happen. It's different from that. Yeah, witches are cool.
Yeah.
But I guess, it's just all these loan maturities, like $6 billion at least in CMBS loans, most likely a lot more. We have student loan repayments that are starting in October.
Totally.
There's a lot of, and again, it's like there's a lot of things because of the pandemic and that influence human behavior and activity that a lot of things started happening in the fourth quarter of 2021. That just happened to be like the time, not just real. It's like all of these other things that we're not even cued into.
Yeah.
But so, and again, we're at the end of August, Matt, September. We knew, again, looking at all the charts and the metrics, it would be a dead quiet summer.
Yeah.
The eye of the hurricane is above us.
Yeah.
Quiet.
There's a lot of, this is the other side. One is apartment supply, loan maturities, student loan repayments. I think that still, expenses are still bugging a lot of people. And my point about this, to come back to the RealPage article, they are talking, and it's true, I'll grant them that multifamily permitting is down by almost a third. I think the most interesting part is the fact that single family permitting is completely diverging. It is increasing, whereas multifamily permits and starts are decreasing. I think that is an effect of, you can't buy an existing house. No one wants to give up their house. So you got to build new ones. So that's the reason why that is happening. But I will couch this RealPage article in a larger frame of the Fannie Mae article, which shows that multifamily supply trends, there are nearly 730,000 units expected to be built by the end of the year. Now that's expectations, but 500, 400, those were big, healthy numbers for completions in any year.
Oh yeah, we were like just above 300 a couple of years ago.
Yeah,
so we're talking about doubling that.
And their point is that yes, I'm sorry. My point for these two articles is yes, permits are down 1/3 from last year, but the new supply coming online will be greater than the gap of permits. Now, my joking comment was that, and again, this shows our bias here, is that sellers are going to see this gap in permits and say, oh yeah, well, my price is so high because in 2 years there's going to be a supply crunch. I don't think that we're going to really feel the brunt of that impact of the supply crunch because some of this construction is still going to be spread over. Some of that 730,000 is going to be spread over the next 2 years just because of delays that we all know and love. And the new supply now is going to still be felt, I think, in a year or two as it kind of ripples through. They know that the supply and demand will rebalance quickly due to demographic trends, et cetera, et cetera. But it's not going to happen instantly. And you can't ignore the fact that there is new supply. 2023 was the year that supply actually had an impact. We were building and, things came online in 2022, but the rent growth absorbed it. It was like, we couldn't do anything wrong. But this year, gravity is true. Supply and demand do work. And that effect is going to still continue in 2024. It's really the delayed permits that's a 2025 problem. So we still got a whole nother year.
I agree. It's a 2025 problem, and maybe it should smooth itself out. I think at the end of the day is where we will not have built enough housing.
Yeah,
that's going to be the problem. Is that things have picked up for a time being, and we have a big concentration of deliveries in specific markets, but like it's still not going to be enough. That's just filling previous holes.
Yeah,
like of a decade of not building enough. And so we are getting our way dug out of that hole, and then we're going to stop and we're going to slip back a little bit. Then we're going to get a little bit closer, but it's the only way to get out of this affordability issue is just to build.
Yeah. And that's, and to RealPage's credit, there's been a slew of articles and LinkedIn posts from Jay Parsons, Carl Whitaker talking about look, here's a market that built a lot of units. The rent went down. Here's a market that didn't build a lot of.
Here's the evidence.
It is as a cause and effect as you can really get. And it's reassuring in a way.
It is. It's reassuring. It's also refreshing though, because it puts like facts in the face of certain social activists that don't really haven't taken the time to try to understand economics and are mostly going off of like feeling and little anecdotes. But when you look at the actual,
you talk about Minneapolis.
No, I'm not specifically.
I'm gonna look at a bunch of articles, and I'll bring this up again.
Oh, you know
next week.
Speaking of Minneapolis, there's an article that we should talk about. It's a very funny take, basically celebrating Minneapolis. Because they're like, look, our inflation's so low, we're doing really good.
Maybe it's the same.
Everyone left.
Well, okay, that's what you say. I'm gonna read that New York Times or New Republic or Huffington Post article, and we'll see.
Yeah, but it's like, but it was because we basically talked about, like, it was a cluster. It wasn't a great situation. Yeah, uncertainty, people wanting to leave. Things were already that's the thing. Rent was already really expensive in Minneapolis.
Yeah.
And then people have left, and there was no rent growth, and like that's like not a good sign. That means there's not a demand for housing. And then these other outlets who, again, don't really want to understand economics very well, they just have a specific narrative, are celebrated as a success, and they're basically saying they're celebrating like the decline and the decay of like
cheaper rent.
The decay is cheaper. This is nice.
Yeah,
like it's not anything to celebrate.
Well, I will read those articles and I'll tell you what they're celebrating.
And it's like, it's cheaper there. Move down to Indianapolis or somewhere in the Sun Belt where it is actually cheaper and nicer.
Yeah. That is a good point. There are affordable ones that are, have a little bit better legs under them. I think that there is a part of Minneapolis being celebrated as a government policy-driven approach to lowering housing costs. That's one perspective that I'm sure I'll read about.
Yeah.
And then the other perspective is like, well, if you look at this from the perspective of a market, the lower prices are the product perhaps of lower demand, which is maybe a problem.
Yeah. It's like we made this this place so undesirable to live.
We don't
that the rent has come down.
Yeah.
Like that's how that's the roadmap. Just make it so undesirable.
Their policy decisions have made their population less demanding. Maybe not. We don't have the demands that we used to have.
That's true.
That's a stretch. That's a word game.
Well, same thing as San Francisco. They're declining rents. Great job.
Yeah.
It's what we should all model.
Very good point.
That's what we should model all society off. Minneapolis and Seattle.
I've got some good mental images right now.
No, there's I haven't spent enough time in Minneapolis to say they had a lot of redeeming qualities.
Yeah.
Solid music scene.
Totally.
Understand. San Francisco, a lot of redeeming qualities also. Beautiful, great, part of the country, some really good people, but it certainly has some challenges, and I think they will both recover because the spirit and desire is to do it. But politicians will most likely be the ones in the way. And again, I don't know, so I want to hold judgment on the fine government officials in the city of Minneapolis.
I'll tell you who gets credit for it.
I'm a little themselves. Themselves.
That's right,
Matt. Jam-packed episode today. I recommend everyone go back and listen, watch, and share with your friends because I need to know. Make sure you're subscribed to the Gray Report on the Gray Capital YouTube channel. Get in the podcast wherever you like to get your podcast. You're on the go, in the car, on the mower.
Plug a new podcast that is coming out very soon, The Complex, a deep dive into the big and small of apartment property management and a multifamily property known on the street as The Complex. I don't know if that's how she words it, but we have Katrina Green, the director of property management at Gray Residential. She is probably the smartest, best person in the office besides Spencer.
Yeah, no, she is way smarter than I am, especially at on the operations side in property management. A ton of experience, multiple decades of working in a lot of different aspects of apartment operations, property management, and what I have seen throughout, the sphere of multifamily media, if that is a niche as it is, or real estate. Media that's out there, consumable content, a lot of it's the same stuff, which we try to do something different. Well, a lot of it, what you see is, an investor is going to bring on another investor and they're going to say, tell me your background and tell me about your first deal and tell me about your challenging deal. What books have you read recently? And all of that is great. There's some amazing stories out there and there's just a lot of it there's a lot of it.
Mm-hmm.
We wanted to take a little bit different approach with this show, Matt, and talk more about the market, macroeconomics, how it all plays in, strategy, but specifically, we wanted to make sure we were ourselves staying up to date with all the latest information, research, And then, hey, we don't think that everyone else is getting all this information. It's not being disseminated efficiently. Let's disseminate it. Let's talk about it.
Yeah.
Started the newsletter, and then we're like, let's talk about what's in the newsletter. But really talking about, articles, data, and research.
Mm-hmm.
Not every show's doing that. There's a handful others that have kind of, I don't want to say taken our lead, but like there's a couple others out there. Similarly, is very little content on true apartment operations and property management. It's like, I don't know why. And I don't even hear many multifamily investors, usually they're not even the ones doing it, they're not exposed to it, talking about true operations and property management. Part of it is because you're hiring a third party company to do it, but like you're investing in a business and you don't know how the business works or operates.
Yeah.
Like it's more than just cap rates and interest rates and rent growth and assumptions and talking to a broker and a lender. Like that's all. Yeah, that's all part of it.
It's funny that a layperson, they think apartments. That's the first thing is they think property management, and then you get into a mode where all you think about is the spreadsheets
because there's so much. And personal example, you can't do all of it at once.
Yeah,
and I did at first, and I was looking to buy some of my first like buy and holds. I was like, I'm going to be evicting people and doing all the property management, and then I realized I'm like, no, the best what most people do is they hire that out because it's like that's a whole other business, and I'm not an expert, and I can't manage every single property myself, and so you become so far removed from it, and because it is a volatile business. It is it can be chaotic. You're dealing with a lot of people, personalities.
It's where you live, it is. I was saying this, if it would be a hit reality show if it weren't for the privacy liabilities. If you had this is where people live every single day. You get everyone, and the
residence standpoint, but also, your site teams also, it's people and personalities to manage that. If you're just hiring a third party property management company, you don't get any of that information. And then you're wondering why things aren't going a certain way. Yeah. And it's not until you get into the real details, which can all of a sudden be like personal.
There are so many times, and I'm not going to name any specific, because where something dramatic will happen, and Katrina's like, oh no, that stuff happens. Here's the plan we have for it. And or like some weird things like, no, here's what you have to do because this is a huge liability you weren't even thinking about. There are so many times I have these conversations with Katrina where she's like, where we talk about this big thing you wouldn't even think about, and those are the conversations I have with people on the weekends. It's like, did you know that if such and such happens, like we shouldn't even be allowed to do this? You know what I mean? Like, like here's an example. Yes. You can't do don't do wellness checks. That opens you to a whole kit. But what if someone's not paying the rent? Are you going to knock on the door with 2 weeks? Like, no. That's the police's job. You don't want any,
There's a lot of lessons through experience, and it's been very humbling because you can say like, no, this seems like the right thing to do, and it's like, okay, I've tried that.
Yes, exactly.
This is what happens. Like, okay, I didn't think of it that way. Wow, I underestimated people in general, or under or overestimated just people in general, and so. One of the reasons why we decided to bring property management in-house is because I didn't like the separation and the compartmentalization. It's like, I want the cleaned up like report and like, let's just talk about very high end KPIs and then assuming that the whole team down the chain is just like super professional, buttoned up, and has the same like mindset mentality that like maybe we do, and are looking at things through the same lens, or even equipped to have the experience to look at it the same way that we are. The reality is that like they're not. Yeah. Like we're bringing people on. Oftentimes they've never worked in the industry, or it's relatively entry level. So they don't have the training, or even worse, they have a lot of training, but it's like really bad training. They've learned bad habits. There may be an existing culture at the property that's just toxic. Yep. And you can only deal with so much of that as an asset manager in an asset management meeting. Yeah. Just like being totally honest. And so we want to get our hands dirty a little bit so we can have full control over the product in the process and control it, because like you've heard me say this a lot, Matt, I'm not interested in just doing volume and doing deals just to do deals. It's like, we want to do quality work. Yeah. We got one life building this business. Like let's make a name for ourselves of doing like the right thing and doing a good job at it. Yeah. With the belief that we can make more money at the end. By doing that, it can be a longer term process. But I do think it's the right way forward. How can we do that when we're just, outsourcing it and assuming the best of, a third party partner that inherently do not have the same objectives as you do.
And I think that there is room if you get now. Sad for everyone else that they don't have Katrina.
I feel bad,
but like there is room. It's not impossible for someone to start up and try property management. It's not like you have.
It's a great career because you can get in, and if you're willing to learn and like work decently hard, it can be a great path of advancement and somewhere where you can come in. Not in the mail, but essentially the mailroom, and you can work your way up to the corporate level. And again, it's like my vision and dream is that like someone comes in to Gray Capital and works their way through site level.
Yeah.
And, they're in my role one day where I'm like, look, you're better. Like, and again, they're like, oh, I would love to be like, you're way better at this than I am.
Mm-hmm.
You're going to take over.
Yeah.
I'm going to step aside.
And
like that would be in my book, that would be the absolute success.
Yeah. Yeah. And it's hard to do that, especially if it's third party, but you'd never know how much someone cares, and you could care a lot, and it's easy and it's better to convey that.
Why should they?
When you're doing the property management, when we have it in house, it's easier to have like the fact that you care bleed over into everyone. But if it's a third party, they don't. Well,
they're not your employees.
Yeah.
They're just like, you're just like kind of the client that they have to deal with.
Yeah.
From ownership, and people they're like, they've been burned before. There's a lot of bad ownership. There's a lot of bad management.
Yeah.
And so it's the opportunity, but everyone's coming into it like a little jaded because they're like, sure, I've heard that before. Like, why should I trust you? Why should I put everything in there? And that's, I think that it's a big challenge that like, I don't know when we're going to solve it, but we're up to the task. So so Katrina's would bring on industry professionals, vendors, folks that, are, in multifamily property management. You're going to be getting a different perspective. And so if you are a multifamily investor that hasn't come up through property management, I would say that it's near essential. It's required watching and listening because you're going to learn so much more than you did prior. If you are in property management or you're doing property management, want to do it, it's also essential because you're going to be gaining decades of experience or learning from someone with decades upon decades of experience, bringing in absolute experts in the industry, and it will give you an edge. Like if you're just in the business, just the talking points and just understanding what's going on, it's a difference between being put on the list for advancement or not. Yeah.
And things are changing so much. There's new, whether it's new software or new ideas that come up in property management.
There's so much changing, and real estate's so slow to move, but we're so passionate about doing things a better way that we can while not reinventing the wheel. And you don't want to be left behind. You want to be one of those on the leading edge.
Yeah.
And like, I love what Katrina said. It's like, if I interview somebody and they start asking us about what technology we use, we know that they're engaged.
Yeah.
It's like, what if they're like, what's your tech stack? What am I using? What's my CRM? Okay, you're serious about this. You want to make sure you've got the tools so that you can do the job.
Yeah. And
you're so many like whatever.
Yeah. And so many out there are still carrying clipboards when they should be carrying laptops.
Yeah.
And that's why I think it's exciting. There is an opportunity. It's not just like, hey, it's not just like, oh, you're making a sandwich too slow. Let me go and try it. That's not that. It is the fact that like you can do an adequate job if you're an investor asset manager trying to take property management in-house. There's really opportunities to excel and like get to the top of,
There is. It's an interesting curve though, because I feel like, we're now doing better than we were before, but there is like, even though we thought we were prepared, we took a lot on quickly. There's definitely like we didn't know we didn't know.
Yeah. Yeah.
And then it's like, oh, there's reasons for all this.
Yeah.
And then it's like, it's all the right, and getting the right people in place. So the complex, the first episode is debuting September 5th.
Yes.
September 5th, the complex with Katrina Green, available wherever you get your podcasts. It's going to be on the Gray Capital YouTube channel. So if you're subscribed to Gray Capital YouTube channel, you're going to get the complex, because not only is apartment multifamily complex, but people call them complexes.
Yes, I like it.
I think it's a really good play on words. I'm excited. So stay tuned. Matt, great episode.
Thank you.
Let's eat some lunch with managers. Let's do it. All right. Thanks again for watching. See you next time on The Great Report.